there, and welcome to the deep dive. Today, we're really cutting through all the noise, trying to bring you the most vital insights from the latest market data.
Yeah, we've pulled together a whole stack of recent analyst reports, market forecasts, and a really in-depth look at the S&P 500's performance. All data is current as of August 22, 2025.
And our mission today is pretty simple. Sift through these numbers, find the really important nuggets, and figure out what's actually driving the market versus, what might just be hype. Today, the focus is squarely on the S&P 500's earnings power and, crucially, its current valuation.
Right. Where's the growth coming from? Which sectors are hot, which are not?
Exactly. And is the market getting a little ahead of itself? By the end of this, you'll have a much clearer picture of the forecasts for the rest of 2025 and heading into 2026. Let's get into it.
Let's do it.
So let's kick things off with the overall mood.
Hmm.
The S&P 500's had a strong run. Is it still like full steam ahead, or are we starting to see things cool down a bit?
Well, it's interesting. The data suggests a kind of nuanced view. The S&P 500 is poised for continued, albeit moderating growth.
Okay, moderating growth, so not stopping, but maybe tapping the brakes slightly.
Exactly. It's not a sudden halt, more like a downshift. And the story behind that is this mix of, ongoing tech advancements, especially AI,
Right.
and an economy that's actually proving pretty resilient,
Right.
even while it is gradually slowing. It might suggest a more sustainable pace, actually.
Okay, that makes sense. Moderating. Let's put some numbers on that. What are the consensus forecasts for earnings per share, EPS, and revenue growth? What are analysts expecting?
Okay, so for fiscal year 2025, the consensus estimates look quite robust. Revenue growth is projected at 5.8%.
Still pretty solid.
Yeah, company's still bringing in more sales. And maybe more importantly, EPS is expected around $260. Now, that translates to a pretty significant 14.8% growth year over year.
Wow, almost 15%. That's a big jump in profits.
It is. Then looking just a bit further out, fiscal year 2026, revenue growth is projected at 6.1%, so still strong there, and EPS around $280.
Okay.
But see, the growth rate there moderates to 7.7%, still healthy, but, maybe suggests the fastest expansion burst is behind us for this cycle.
Right. So strong now, slowing a bit later. And what about profit margins? With that kind of growth in 25, are companies getting more profitable or just, working harder?
No, they're definitely getting fatter margins. That's a really crucial piece. The projected net profit margin for FY 2025 is 13.0%.
13%.
Yep. And that's not just a number. It's like the highest level we've seen since 2021.
Okay.
And to give you context, the 5-year average is 11.5%. So 13.0% is significantly above that. It tells us companies have pricing power, they're managing costs. It's a sign of good corporate health.
And for 2026, does that hold?
It moderates slightly down to 12.8%, but still, well above those historical averages. Profitability looks set to remain pretty strong.
Okay, good to know. Now, for a long time, it really felt like the whole S&P 500 story was just about like 5 or 6 huge tech companies doing all the heavy lifting.
Right, the mega caps.
Exactly. Is that still the case? Or is this growth we're seeing finally starting to broaden out a bit?
That's a great question, and this is where the narrative is really shifting. The report clearly states that earnings growth is expected to broaden beyond the mega cap technology leaders that dominated in 2024.
Okay, that's a big deal.
It is. Now, don't get me wrong, Infotech is still leading the pack, estimated 21.2% EPS growth for FY25. That AI demand is just relentless.
Sure.
But we are seeing really impressive strengths from other parts of the market stepping up. It makes the growth feel potentially more sustainable because it's not all resting on one sector.
Okay, so if tech isn't the only engine anymore, who else is stepping up? Which other sectors are contributing significantly, and what's driving them?
Well, beyond tech, 2 other sectors really stand out. First, you've got healthcare. Projected EPS growth there is a very impressive 18.5%.
18.5%. Wow. What's behind that?
It's mainly a combination of a wave of new drug developments, medical tech innovation, and just the steady demand from, an aging population globally.
Right, demographics.
Exactly. And that's providing a strong tailwind, even with potential sort of policy headwinds like drug pricing debates always lurking.
Okay, healthcare. Who's the other one?
Industrials. They're looking at a robust 16.3% EPS growth.
Industrials. What's fueling that?
It's pretty fundamental stuff, actually. You've got strong support from onshoring trends companies bringing manufacturing back, or closer to home.
Supply chain resilience.
Precisely. And alongside that, there's just a lot of infrastructure spending happening, both public and private, building factories, upgrading logistics, that directly benefits industrial companies.
Fascinating. So healthcare and industrials joining tech, but it can't all be good news. Which sectors are struggling a bit? What headwinds are they facing?
Yeah, there's always another side. At the bottom, we see three sectors in particular. Energy is looking at an estimated negative 5.8% EPS growth.
Negative. Why the drop?
It's mostly about difficult comparisons from prior years. Remember, 2022, 2023, oil and gas prices were sky high. Profits were enormous.
Right. Tough act to follow.
Exactly. So even though current earnings might be decent, compared to those record years, it looks like a decline. Yeah. Plus, oil prices have moderated.
Okay. Energy. Who else?
Real estate, only looking at about 4.1% EPS growth. They're really feeling the pressure from the whole higher for longer interest rate environment.
Makes sense. Borrowing costs.
Yeah, higher rates hit everything, financing for commercial properties, mortgage demand, overall transaction volumes. It's just a tougher climate for them.
And the third one?
Consumer staples, projected around 6.5% EPS growth, which, is positive, but lower than many others.
Why are they lagging?
They're getting squeezed on margins and seeing slower growth now that inflation is normalizing a bit. During peak inflation, they could pass costs on easily. Now, consumers are more price sensitive. Costs are still sticky. It makes growth harder to find.
Yeah, you can really see how those big picture economic trends rates, energy prices, demographics, supply chains are playing out directly in sector performance. It's all connected.
Absolutely. It gives you that holistic view.
Now, a key narrative you mentioned and that the report emphasizes is this broadening AI boom. We touched on tech, but can we clarify what that really means? Is it just NVIDIA selling more chips, or is it bigger? How is it influencing these different sectors?
It's definitely much bigger than just the chip makers, although they're like the essential foundation, right?
Sure.
The broadening AI boom idea is that the benefits are starting to diffuse outwards from the core semiconductor guys and the big cloud providers into the wider economy. Think of it like ripples spreading out.
Okay, ripples. Give me an example.
Okay, so in infotech, yes, it's still about that massive demand for NVIDIA chips. For Microsoft, Amazon, Google, cloud services, they're building the AI highway.
Right.
But now, other sectors are using that highway. Take industrials, which we just talked about. Part of their strength comes from increased capital spending related to AI.
How so?
Companies across different industries are building new AI-specific data centers. They're upgrading factories with AI-powered robotics. They're reshoring operations that need more advanced automation. So a factory using AI for, say, predictive maintenance, that's the broadening boom in action.
I see. So it's the application of AI spreading out, driving spending in other areas.
Exactly. It's becoming embedded.
That makes sense. So with this evolving landscape, how are the analysts reacting? You mentioned positive sentiment earlier. Has that shifted recently?
Yeah, analyst sentiment has actually turned increasingly positive over the summer. That's quite a significant development.
Why the shift?
It seems to be a mix of things. Strong Q2 earnings results came in, giving some, tangible proof that companies are executing well. And the general economic outlook just became a bit more optimistic. And specifically, we've seen the aggregate EPS estimates for FY 2025 rise higher by about 2.5% just in the last 90 days.
2.5% revision upwards. That's pretty meaningful across the whole index.
It is. It's not just a small tweak. It shows analysts are genuinely upgrading their expectations for corporate earnings.
And what about the earnings revision breadth? Is this optimism widespread, or is it just a few big companies pulling the average up?
No, the breadth is positive too, which is important. It tells us how widely spread the optimism is.
Right.
For every company that had a negative EPS revision in the last month, 1.8 companies had a positive revision.
Okay, so almost 2 positives for every negative.
Exactly. A ratio above 1 like that suggests it's a pretty broad-based optimism, not just, isolated good news.
Which sectors are seeing the most positive revisions?
The leaders there are infotech, industrials, tying back to what we discussed, and also financials.
Okay. Any areas where revisions are still leaning negative?
Yes, it's not universal. Healthcare still sees more negative revisions, likely due to that policy uncertainty we mentioned. And Fenergy, for the comparison reasons, and consumer staples are also seeing more negative than positive revisions. So it's optimistic overall, but with some specific areas of caution.
Right. So pulling it together, analysts are more positive, revisions are broadly good, but there's always a but. Does this mean the market's getting expensive? Are we paying a premium for this optimism?
That is the million-dollar question, isn't it? And the answer, based on the data, is yes. The market is trading at a premium to its long-term historical averages.
Okay.
And that premium directly reflects these high expectations for earnings growth that we've been talking about. The S&P 500's forward 12-month PE ratio.
Price to earnings.
Right, the price you pay for expected future earnings.
Why?
It currently stands at 22.5x.
22.5. How high is that, really? Let's put that in historical context for everyone listening.
It's definitely elevated. If you look back, the 5-year average PE is 21.0x.
Okay, so already above that?
Yep. The 10-year average is 19.5x, and the 30-year average is 18.0x.
Wow. So 22.5x is significantly above all those averages.
Significantly. It tells us investors are placing a big bet on future growth materializing. It suggests maybe even, pricing in a near-perfect outcome. Confidence is high, but it leaves less room for error if things don't go exactly as planned.
Less margin for error. Okay. And what about the PEG ratio? Price earnings to growth. That often helps gauge if the price is justified by the growth rate. How's that looking?
Right. The PEG ratio tries to balance the PE with the expected growth. So you take that forward PE of 22.5x, and you divide it by the forward 12-month EPS growth estimate, which is around that 14% we talked about.
Okay.
That gives you an implied PEG ratio of approximately 1.6x.
1.6. And generally, anything over 1.0 is seen as potentially expensive, right?
Generally, yes. A PEG over 1.0 suggests the valuation is high relative to the expected growth rate. So 1.6x definitely indicates that investors are paying a relatively high price for each unit of expected growth. Again, points to strong optimism, maybe even stretched valuations. The market's really counting on that growth coming through.
Got it. Okay, one last check on valuation, especially for income investors. Dividends. How does the S&P 500 look right now if you're looking for income?
Yeah, for income seekers, it's less appealing right now. The S&P 500's current dividend yield is only 1.1%.
1.1%.
Yeah, which is quite a bit below its historical average, which is closer to 1.9%.
Okay.
And it may be more importantly, the report highlights it's significantly less attractive than the current 10-year Treasury yield, which is sitting around 4.3%.
Ouch. So you can get over 4% pretty safely from bonds versus just over 1% from stock dividends, plus the stock risk.
Exactly. That disparity really reduces the appeal of equities if your primary goal is income generation right now.
Okay, so that paints a really clear picture. High optimism, high valuations, low dividend yield relative to bonds. The report even says the market is pricing in a near-perfect scenario of strong growth and moderating inflation. That sounds precarious.
It does underscore the level of expectation baked in. When you see that forward 12-month EPS growth forecast around 14%, remember the 10-year historical average is only 8.0%.
Right. Huge difference.
So predicting 14% growth and having a high PE ratio on top of that, it really suggests the market believes things will go very smoothly. No major bumps in the road.
But life rarely goes perfectly smoothly. So let's talk risks and opportunities. What are the potential upside risks? What could make things even better than these already high expectations?
Well, the primary upside risk is probably centered around AI. What if AI adoption is even faster or leads to even bigger productivity gains and profits than analysts are currently modeling?
Okay, AI overdelivers.
Exactly. That could push earnings even higher. The other main one is achieving that perfect soft landing scenario for the economy.
Right.
If inflation cools nicely, growth holds up, and the Fed feels comfortable starting to cut interest rates sooner than expected, well, lower rates could definitely fuel more market growth.
Makes sense. Lower borrowing costs, more investment. Okay, now the flip side. What should we be watching out for? What could potentially throw a wrench in these optimistic forecasts? What are the downside risks?
The downside risks are definitely worth serious consideration. One major one is inflation proving stickier than hoped.
Still a concern.
Absolutely. If inflation stays stubbornly high, the Fed might have to keep rates elevated for longer, or worst case, even hike again. That increases capital costs, slows things down.
Yeah, okay, persistent inflation. What else?
Geopolitics is always a risk. Any major escalation in current conflicts or new ones emerging that could disrupt supply chains, spike energy prices, and just create a lot of uncertainty.
Yeah.
Markets hate uncertainty.
True.
And finally, there's the risk specific to the AI boom itself. Could the massive investment cycle turn out to be, well, a bit of a bubble?
The B word.
Yeah. I mean, if the promised returns from all this AI spending don't materialize quickly enough, or if competition just gets brutal and erodes margins, you could see a sharp pullback in tech spending and a painful revaluation of those high valuations, especially for the most hyped-up names.
Okay, so real risks on both sides of the equation there. Inflation, geopolitics, and the AI story itself potentially hitting a snag.
Precisely. It's a complex picture.
And that really wraps up our deep dive into the S&P 500's earnings and valuation outlook. We've definitely seen this picture of, robust growth, but growth that's expected to moderate.
Fueled by that broadening AI boom, resilient profitability.
Right, and increasingly positive analyst sentiment. But, and it's a big but, we've also clearly seen the market is trading at a premium. It seems to be pricing in, as the report says, a near-perfect scenario.
Yeah, the expectations are high.
So hopefully you now have a much clearer understanding of those key drivers, the sectors leading the charge, the ones facing headwinds.
And those critical upside opportunities versus the very real downside risks.
Exactly. So maybe here's a final provocative thought to leave you with. Given that the market is pricing in such a near-perfect scenario right now, how much room does it really have for any surprises? Whether those surprises are good or bad, what happens if something unexpected occurs? How might the market react given these stretched expectations?
That's the key question going forward. What's the tolerance for deviation from this perfect path?
Something to definitely keep in mind as you navigate the landscape ahead. Thank you so much for joining us on the Deep Dive.
Thanks for having me.
We'll catch you next time for another journey into what matters most.